I'm Rick Kahler. Well, I don't know if you are a reader of U.S. News and World Report, but the recent edition, which was the August 6th, 2007 edition, featured Warren Buffett. Now, I think about everybody knows Warren Buffett as one of the wealthiest people, not only in the United States, but the world. The headline read, "How to Make Money the Buffett Way." Now, maybe a more appropriate headline might have been, "Don't try this at home." According to the magazine article, somebody who had invested $1,000 with Buffett in 1956 would be worth $27 million today. Now that's an annual return in excess of 22%. Pretty impressive by anybody's standards. It certainly is more than I or other reputable investment advisors would lead our clients to expect over the next 51 years. Most prudent investment analysts are expecting total returns from a 100% stock portfolio of between 8 and 12%. Now, does this mean that every investment advisor is misleading our clients or missing some simple secret? Because we're not saying you can earn 22% over a 51-year period. No, that's not the case at all. Investing in individual companies rather than building a diversified portfolio by using mutual funds is just not a wise option for ordinary investors. In fact, a Dalbar study done between 1983 and 2003 showed that the average investor earned 2.5% a year during that 20-year period of time. Inflation was 3%. The S&P was 12.5%. So this really isn't for the average investor. I mean, suggesting that you try to make money the Buffett way makes about as much sense as suggesting you try to play golf the Tiger Woods way. If playing golf is your dream, if you've got the talent, if you're willing to take the risks and do the hard work, the practice that it takes to succeed, well then go for it. Of course, it might have helped if, like Woods, you started learning the game when you were 3 or 4 years old. But just as golf is Tiger Woods' business and passion, investing is Warren Buffett's. He started his first investment company when he was in his 20s. Researching companies' performance, management, and future possibilities, well, that is what Warren Buffett does. It's his day job. He understands economics, and he's skilled at evaluating balance sheets, weighing management competence, assessing probable risks against probable gains. I mean, investing is his talent. It's his unique genius. He's obviously passionate about it as well as he's very good at it. Now, studying the masters is one way that we can increase our understanding of the activities that are important to us. A recreational golfer might enjoy and learn from a book or video about how Tiger Woods plays the game. An average investor might learn a few things from a book about Warren Buffett's investing strategies, but this doesn't mean that they should quit their day jobs. A weekend golfer isn't going to become another Tiger Woods, and neither is a part-time investor going to become the next Warren Buffett. Now, in my 25 years of managing money, I've had a number of clients insist that they place a portion of their portfolios in individual stocks and be like Warren Buffett. After warning them of the risks, I typically acquiesce and set aside 5 to 10% of their portfolio and let them trade to their heart's content. The experiment typically lasts about 2 years, and the result is very typical too. At that time, they figure out that the mutual fund portion of their portfolio has garnered higher returns with far less volatility. There is, however, one thing the average investor can learn from Warren Buffett. The U.S. News article quotes him as saying, "You need the temperament to control the urges that get other people into trouble in investing." It mentions his patience and his ability to buy when other people are selling. Now, in other words, you need the ability to make your investment decisions consciously. You are likely to be a more successful investor if you understand the unconscious beliefs you've developed about money and investing and realize how those beliefs guide your financial choices. Identifying and learning how to change your money scripts can help you avoid the knee-jerk reaction of panicking and selling at precisely the wrong time. And these are mistakes that so many novice investors make. Can also help you avoid another big mistake, and that's thinking that you're Warren Buffett. Thanks for joining me.